Alphabet CEO Sundar Pichai sold 22,500 shares of Alphabet's Class C stock, worth approximately $3.74 million. And that is just one of many sale transactions in the recent year. As we know, there can be hundreds of reasons to sell a stock, so we shouldn't jump to any conclusions too fast. But if a CEO is selling shares of his company, then it may be a good time to revisit Alphabet, analyze it and value it to understand where we are at, and should we follow the lead of Sundar Pichai. If you were to invest $1,000 into this company 10 years ago, you could buy around 37 shares, and now they would be worth something close to $6,135. And this company just recently started to pay dividends, so you would also get $14 as dividends. So if we add together those numbers, we get $6,149, and that is a gain of 515% in 10 years. I think that the possibility of such results is what gets people interested in investing. Individual insiders, that is a check. 10.4% of the company is owned by individual insiders, and we would like to see this number over 2%. So in case of Alphabet, the management definitely has its skin in the game. And are individual insiders buying? That is an X. We see a number of insiders selling their shares. And if we look closer at what Sundar Pichai is doing, we see that he's actually selling shares almost every month. Since December 2023, he sold shares worth over $70 million. So that is a meaningful sign. He still has a lot of shares, but he's not willing to put all his eggs into one basket. And do super investors own this company? That is a check. 33 super investors own this company, including people like Lilu, Bill Nygren, whose stock portfolio I recently analyzed, or Bill Ackman. And are super investors buying right now? That is a check. They bought 4.8 million shares in Q2 2024 and sold 3.3 million shares. Return on invested capital, that is a check at 17.3% 10-year median returns, and we want to see this number higher than 10%. And what do we know about net profit margin? It is a check, averaging 23.6% over 5 years. And the sector median is just 2.9%. And there are only 3 companies with higher net profit margins in the industry, including Meta. And now let's take a look at share buyback. It is a check. They bought back 7.8% of shares in the last 10 years. That is nice. And the debt? It is another check. It would take just a couple of months to pay the long-term debt with a current free cash flow. So Alphabet does not have any problem with debt. Revenue growth, that is a check at 18.7% 10-year compound annual growth rate. And we would like to see this number higher than 10%. So that is a nice growth. And free cash flow growth, that is also a check at 19.9% in the last 10 years. Great. And earnings per share growth, that is a check at 20% in the last 10 years. So it's only getting better. It's incredible that such a huge company can still grow so fast while having almost no debt. So it is an organic growth. It just doesn't get any better. The dividend yield is 0.5%, so shareholders can expect to get 80 cents annually per every share. And the payout ratio? That is an X at 2.8%, and we want to see the payout ratio somewhere between 20 and 50%. So the dividend is really small, but they just started to pay dividends, so we will see where it will go. And what about dividend growth? It is an X. They paid their first dividend just a few quarters ago, so of course we can't calculate the 5-year average growth rate. Price to earnings ratio is 23.3. That seems like a lot, so we should not expect Alphabet to be cheap. But on the other hand, Nvidia has a PE ratio of 63. Meta 29.4, and Microsoft has a PE ratio of 35.9. So if we would use comparable company analysis, it wouldn't look that bad. And by the way, if you would like to learn to value any company using discounted cash flow analysis, comparable company analysis, dividend discount model, or PEGI ratio, then check out our new course on company valuation. The link is in the description. Okay, so let's use a discounted cash flow analysis and let's find the intrinsic value of Alphabet. So in the low scenario, we will estimate a growth of 10% for the first 5 years and then 8%. In the medium, 14% and then 10%, and in the high scenario, 18% and then 15% growth. So the low scenario predicts that Alphabet will grow at half its recent rate. The medium scenario suggests growth will remain substantial, but that it will slow down slightly. And finally, the high scenario predicts that Alphabet will continue growing at a similar pace as it has over the last 10 years. So with such estimates, the intrinsic value in the low scenario is $105, in the medium $131, and in the high scenario, $181. But we have to always apply a margin of safety to those prices. I use a 30% one, but you can use any margin that makes you feel comfortable. And with such a margin, we get in the low scenario $73, in the medium $92, and in the high one $126. And the current price is around $163. So Alphabet is expensive right now, but the difference isn't massive. I'm actually surprised. I expected it to be much more expensive. So let's compare Alphabet to some other interesting companies. If we go to our Stock Ranking Pro, we have a brand new feature that allows us to sort the ranking by industry. So let's filter the ranking and leave only interactive media, IT, software, and technology hardware. And instead of almost 100 companies, now we are comparing only 11 of them. And if we sort them by the best overall score, Alphabet has the third spot. But if we sort them by the difference between the intrinsic value and the current price, we see Alphabet is exactly in the middle. So a strong company, but there are cheaper investment alternatives. On one hand, Alphabet has a fantastic financial health and an incredible growth for such a huge company. On the other hand, it is not cheap. But at least we know what we are paying for, and such quality businesses are not that common. Thank you so much for watching, and see you in the next one.